Goes like this, start with a track, eyes on me, watching my back, just like this, just keep watching. Just keep watching. Just keep watching.
So my name is Nuzulaika binti Safirun, and now I want to present about the Inari Amertron. Berhad operate at the heart of the global semiconductor industry, which power essential technology like smartphone, AI and 5G. As a key OSAT provider, Inari deliver advanced packaging, assembly and testing service for components like RF chip and fiber optic transceiver used in everything for industry equipment to smartphone. With cutting-edge facility in nation China and the Philippines, Inari support high-volume, high-precious manufacturing. The company constantly invests in R&D, collaborating with institutions like MIMOS and USM to stay ahead in innovation, especially in IoT and 5G technology. So more than just technical excellence, Inari is committed to sustainability and corporate governance. It integrates ESG practice to reduce its environmental impact, support employee development, and ensure ethical operation by combining innovation, reliability, and responsibility. Inari Amertron positions itself as a trusted partner in the global semiconductor supply chain. So that's all from me. I will pass to the next presenter.
Assalamualaikum. My name is Ernie Nurshafia binti Jumahadi. Today I will be representing the liquidity ratio of Inari Amertron Berhad for the financial year 2024 and 2023. This include the current ratio, quick ratio, and quick cash ratio. All of this which help evaluate the company ability to meet its short-term obligation. Let's begin with the current ratio, which measure how well the company can cover its current liability using its current asset. So in 2023, the current ratio was 7 ringgit 36 cents, and in 2024 it slightly increased to 7 ringgit 88 cents. This means that every 1 ringgit of liability of the company had more than 7 ringgit of a current asset. This is a very strong position considering the standard benchmark. It's only 2 to 1 ratio. Although they were slightly improved in 2024, it still indicates that Inari maintains ample short-time asset to meet its liability comfortably. Let's start with a quick ratio, which is a stricter version of a current ratio as it excludes inventory and prepayments. This ratio dropped slightly from 7 ringgit 34 cents to 6 ringgit 30 cents in 2024. Even with the decline, this figure are well above the industry benchmark of 1 to 1. This slightly drop might suggest an increase in inventory or prepayments in 2024. Reduce the amount of immediately available liquid asset. However, Inari still remain in a strong liquidity position. Lastly, we have cash ratio, which is the most conservative indicator as it's only considered cash. In 2023, the cash ratio was 5 ringgit 52 cents, and it's increased to 5 ringgit 56 cents in 2024. This tells us that Inari had more than 5 times the cash needed to pay off its current liability in both years. This stability in cash ratio shows that the company has excellent money reserve, allowing it to survive short-time financial pressure without relying on receivable or inventory.
Hi, my name is Nur Aina binti Abdul Majid, and today I will be presenting an analysis of profitability ratio for the year 2023 and 2024 based on the financial data provided. We will look at the 4 key ratios: gross profit margin, net profit margin, return on asset, and return on equity. Let's begin with the calculations. Firstly, gross profit margin (GPM). The formula for gross profit margin is gross profit divided by revenue times 100. The calculations for 2024 is 322,703 divided by 1,478,749 times 100 equals to 21.89%, while 2023 is the 354,968 divided by 1,354,003 times 100 equals to 26.22%. The gross profit margin decreased from 26.22% in 2023 to 21.89% in 2024. This indicates that a larger proportion of revenue was consumed by the cost of goods sold in 2024. The reduction could be due to the increased raw material costs, higher production expenses, or operational efficiency. The trend suggests the company may need to improve cost control, measure or review supply contract and production process. Next is the net profit margin, NPM. The formula for the net profit margin equals to net profit divided by revenue times 100. The calculations for the 2024 is 300,062 divided by 1,478,749 times 100 equals to 20.29%. In 2023, 325,025 divided by 1,354,003 times 100 equals to 24%. The net profit margin also declined from 24% in 2023 to 20.29% in 2024. This reflects a decrease in overall profitability, meaning the company retained a smaller portion of revenue as net income after all expenses. The decline may be due to the increase of administrative or distribution costs, higher taxes, or other operation expenses. These highlight the needs to streamline operations, optimize spending, or boost revenue growth. Apart from that is return on equity, ROE. The formula for return on equity equals to net profit divided by total equity times 100. The calculations for 2024 is 300,062 divided by 3,174,183 times 100 equals to 9.45%. In 2023, 325,025 divided by 2,605,848 times 100 equals to 12.47%. Return on equity dropped from 12.47% in 2023 to 9.45% in 2024. This suggests that the company was less efficient in using its equity base to generate profit. The lower of ROE may result from reduced earning growth or an increase in equity not matched by profit expansions. This could affect investors' confidence, so the company should focus on enhancing revenue generations, managing capital structure, and improve operational efficiencies. Lastly is return on asset, ROA. The formula for return on asset equals to net profit divided by total assets times 100. The calculations for 2024 is 300,062 divided by 3,554,114 times 100 equals to 8.44%. In 2023, 325,025 divided by 2,966,752 times 100 equals to 10.96%. Return on asset fell from 10.96 in 2023 to 8.44% in 2024. This signals a decrease in the efficiency of asset utilizations. Each ringgit of asset contribute to less to net profit in 2024 than in 2023. Possible reasons include underutilized asset or higher asset base without corresponding profit growth. The company should optimize asset usage and ensure capital investment translate into the financial returns.
Good day everyone, I'll be presenting the efficiency ratios of Inari Amertron comparing the financial years 2023 and 2024. These ratios help us understand how well the Let's start with inventory turnover. This measures how effectively the company used its inventory to generate sales. For 2024, the ratio is 6.38 times compared to 5.5 times in 2023. This is an improvement of 0.93 times, showing that Inari is turning over its inventory faster this year. Even though the cost of
goods sold increased by 156 million, the inventory value slightly decreased. This suggests improved inventory management and possibly stronger demand or better supply chain operations. Overall, a higher turnover means less capital is tied up in stock, lower storage costs, and less risk of inventory becoming obsolete. Next, fixed asset turnover. This ratio fell from 2.66 times in 2023 to 1.9 times in 2024, a drop of 0.76 times. This indicates that the company is not using its fixed asset, like equipment and machinery, as efficiently as before. Even though sales increased by 124 million, fixed asset grew even more significantly. This could mean Inari has made big investment in equipment or facility that have not yet produced matching revenue. This might be a short-term inefficiency, especially if the new assets are expected to drive future growth. However, it's important that the company monitors how well this new investment contribute to the revenue. Total asset turnover has also declined from 0.46 times in 2023 to 0.42 times in 2024. This means that company is generating less revenue for every ringgit invested in total assets. Again, although sales rose, total asset increased by 587 million, leading to a dilution in efficiency. This may suggest that new investment, possibly in R&D, infrastructure, or long-term projects, are yet to produce full returns. While this is not necessarily a red flag, Inari must ensure that these growing assets are effectively contributing to its future revenue and not becoming idle or underutilized. Finally, receivable turnover improved from 6.15 times in 2033 to 7.78 times in 2034. This is a strong sign of better credit control and faster collection of payment from customers. Even with the higher sales, receivable dropped by 30.4 million, indicating more efficient billing and collection practices. This enhances cash flow and reduces the risk of bad debt. However, if credit terms are too tight, there is a risk of discouraging future customers. So Inari should aim to strike a balance between maintaining healthy cash flows and good customer relationships. In conclusion, Inari Amertron has shown improvements in inventory and receivable efficiency. However, the decline in fixed and total asset turnover suggests a need to better utilize the growing asset base. Moving forward, Inari should ensure that new investments translate into revenue while maintaining strong operational efficiency and working capital management. Thank you, and I will now pass to the next presenter.
So now I want to present about the leverage ratio, measure how much a company relies on debt versus equity to finance its operation. They help assess a company's ability to meet its debt obligation and its overall financial stability. A higher leverage ratio means greater financial risk but also the potential for higher return. Meanwhile, a lower ratio indicates lower risk but possible slower growth. This makes leverage ratio a key tool in evaluating a company's capital structures and risk profile. So first, the debt ratio formula is total liability divided by total asset multiplied by 100%. In 2023, Inari debt ratio was 12.16% and in 2024, it decreased to 10.99%. This means that is 2024 for every 1 ringgit of asset, only about 11 cents was financed by debt, showing a lower release on debt to fund the asset. Why is this important? A lower debt ratio indicates lower financial risk and stronger financial stability. In mean Inari is depending more to equity, and this will help them withstand economic challenges without struggling to pay debt. From the analysis, it shows that Inari financial health is improving because they are using less debt even when their assets are increasing. This gives them more flexibility and stronger position if they need to borrow in the future. So for action point, Inari should continue monitoring the receivable management and credit policy to maintain this low debt ratio with supporting liquidity and reducing unnecessary dependency on debt. However, debt to equity ratio compared to total equity, showing how much debt is used compared to shareholder equity to finance the business. In 2023, the ratio was 13.85%, and in 2024, it decreased to 11.97%. This decrease means that Inari is relying more on equity financing rather than borrowing, showing a stronger and healthy capital structure. It also indicates that the company equity has increased significantly with their liability only increased significantly. Why is this important? A lower debt to equity ratio means lower financial risk, better investor confidence, and reduced sensitivity to rising interest rate. It shows that Inari is able to fund its growth and operation use internal equity, which help them remain financially flexible. As an action point, Inari should continue strengthen its equities based through returning earning and its strategy funding while maintaining a low debt level. This will help support long-term financial sustainability and resilience in the competitive semiconductor industry. So lastly, I want to present about the time interest earns ratio, measure how easily a company and pay interest expenses, which is learning before interest and tax, or EBIT in simple terms. It shows the company ability to meet its debt obligation. In 2023, Inari times interest earn ratio was 200.10 times, meaning their EBIT could cover interest expenses 200 times over. However, in 2024, this dropped to 116.50 times. This decrease was due to a slight drop in EB and a small increase in interest expense. While the ratio is still very high, the decline suggests a reduced buffer in covering debt costs. Why is this important? A lower time interest earns ratio may reflect reduced inflation in profit generation or rising financial costs. It could preserve future profit margin. So what should Inari do? The company should continue monitoring EBIT performance, control cost structure, and avoid excessive borrowing to maintain a healthy interest coverage. So that's all from me. I will pass to the next presenter.
Lastly is the calculations of earning per share or EPS. EPS is a key financial metric that shows how much profit a company makes for each share of its stock. It's calculated by taking the company's net income and dividing it by the number of outstanding shares. It's a good way to compare companies and track financial health over time.
Now I will explain Inari Amertron's earnings per share or EPS, which reflects how much profit is earned per ordinary share. In 2023, EPS for Ringgit Malaysia 0.09. In 2024, it decreased slightly to Ringgit Malaysia 0.08. This decline happened because net profit dropped from 323.5 million to 300.2 million, while the numbers of shares issued increased slightly. Although the company remains profitable, this small drop may concern investors as it shows a slight decline in shareholder returns. To maintain investor confidence, Inari should focus on boosting net income and controlling share dilution to improve EPS in the future.
To conclude our presentation today, Inari Amertron has a strong liquidity and working capital management. However, there are slight drop in profitability possible from rising costs or pricing challenging. Efficiency in inventory improved, but some assets are underused. With reduced debt and high interest coverage, the financial risk is low. That through the drop in EPS could worry the investor. Moving forward, Inari should control costs, use asset more effectively, and focus on growing returns. Thank you.